Welcome viewers to another video from reitspro.com, and I'm Gaurav Jain, and I bring to you this video today from reitspro, a place for very insightful articles, videos and content on REITs and InvITs in India. Now reitspro also offers trainings, and you can go on to our training section where you can find pre-recorded sessions as well as one-to-one meetings for any doubts and queries. So real estate investment trusts and inflation is the topic. So a lot of us must have heard that as inflation goes up, real estate investment trusts would be a bad investment. One should sell them off. And inflation in India, how it will impact REITs is what we are going to look at it. And the common perception which brings us to this kind of a conclusion is that REITs are like debt instruments. They're quasi debt instruments, and therefore when interest rates will go up, then the REIT prices will go down, and naturally when inflation goes up, interest rates goes up, and therefore this inverse relationship. However, this may or may not be true, and the relationship is very unlike normal debt instruments in case of REITs. Rather, it's a lot more complicated, and there are several factors in the economy, and those have to be factored along with time. The relevance of time is also important in this, because there are things which function as per time. Now inflation, on the important factors that impact REIT prices are three. So we'll look into these three factors. One is the value of assets or properties which a REIT holds. Second, the returns that the REITs generate. And three, the capital structure, wherein what is the debt amount which is taken up. And these three factors have to be correlated with inflation, because inflation obviously impacts interest rates. What is the inflation, what is the risk element, and so on, and that's how one would derive whether interest rates are going up or not. And the second thing is the time horizon. What is the time horizon one is looking at? So the first point is inflation and assets held. We know that in a REIT, properties are the main asset. So in a REIT, it's a combination of, a realty asset is a combination of land and any development. So today we have commercial realty in case of REITs in India. And as inflation goes up, the value of the land and construction both go up. Why the value of the land goes up? Because it's in a metropolitan area, and obviously it's a real commodity, it's a real asset. And the value of the land goes up because land is always in a short supply in urban areas. And the value of construction goes up because whatever goes into construction, whatever the components are, be it steel, be it the copper, be in wires, or cement or any other thing, because of inflation the value of those goods also go up. So both land and construction go up in case of inflation. And now when inflation goes up, so what really happens is that the two components of realty of REITs, in fact one component, which is realty, comprises of two subcomponents, which is land and construction. Now when inflation happens, realty, both land and building, go up, and REIT is also positively impacted because the underlying assets would tend to go up by this reasoning. The second factor we'd consider is inflation and the recurring incomes. Recurring incomes in case of REITs is rentals. Now the impact of recurring incomes of inflation is that inputs go up. For example, the salaries and wages go up. Also the business volumes, the impact of inflation makes the business volume go up. So the nominal value of the business goes up. So both salaries and business volumes go up, and then the impact of this is that first, from the point of view of renters, they can pay more, both salaried and business people. And second, the landlords find it far easier to pass on rental burden. They can always say that the inflation is high, so we are negotiating the rentals, and the increase is accepted better by tenants. So the impact of increased rental incomes because of inflation is that inflation goes up, the incomes go up, therefore the renting capacity or the rentals paid go up because of both factors, capacity as well as negotiation by landlords. And fourth, the price or the value of REITs go up, because the value of REITs is directly dependent on the yields that they are giving. The third factor would be the capital structure. Here the loans that REITs takes do get costlier. Now we need to see the capital structure in light of what is the loan that is taken, what is the cost of finance, and when returns go down, when the returns go down because of this increased financing costs, would the REIT prices go down? So here let's talk about the capital structure of a REIT. In case of a REIT, we have already discussed it in an earlier video also, that SEBI regulations limit a REIT's debt to 49% of the value of the REIT's assets. So there is a limited impact here. How? Let's see the capital structure in a little more detail here. So let's say there is a property which is valued at 100 units. On that there is a debt of 25 units. Let's just assume that way. And in any case, most of the REITs today are in the range of around 15, 20, 25, 30% debt. So let's assume that the debt is 25 units out of 100. So the total, so this particular picture would diagrammatically represent the debt and equity portions of the total assets. And then what happens in case of inflation and increased cost of debt? So this is what would probably happen here. So the 25% of debt would have a negative impact because you're borrowing at a higher cost, but the rest of that, which is financed by equity, there would be a positive impact because of the previous two factors. So in net, it could have a very limited impact probably. The fact that the debt would be priced higher now for a REIT. So as a conclusion, we can say that the three factors are capital assets, the long-term underlying value. Now the point here is long-term underlying value would go up. In the short term, probably there could be dips, yes, but logically in a long-term basis there would be an increase in underlying value. Number two, the recurring income would go up because of both factors, because of negotiation power of landlords as well as renewals by tenants who have a higher paying capacity. Third, the debt finance, because of the regulations there will be limited debt in a REIT structure, and therefore the debt finance cost which would go up would have a limited impact, which would be kind of offset by the earnings on the other part which is financed, or the asset which is financed by equities.